Hey gang, in our last video I introduced the process of depreciation and the 4 methods that you can utilize to come to the correct amounts at the end of the period. In this video I'm going to make sure you understand how to calculate the easiest one of them all, the straight line depreciation method. But first, thanks. So, we already know that there are 4 depreciation methods in which a company may choose in order to depreciate the planned asset at the end of the period. But in this video, we're going to talk about the straight line method. The reason the straight line method is easy because the calculation is so simple that it will give you the correct depreciation amount per year at the same value. That's why they call it straight line. Because if you think about the depreciation expense, all you have to do is calculate it one time and it will continue to be that amount every year, thus giving you an imaginary straight line as you go through the life of the asset. So what's the actual calculation? Your straight line calculation is equal to the cost of the asset minus the residual value. Remember, gang, in the previous video I told you guys that is the actual depreciable cost divided by the number of years of the asset, the useful life. And so whatever that number is, it's gonna go into the journal entry of debit and depreciation expense, credit and accumulated depreciation every year for the same amount. Let's take a look at an example so that I can also show you how to calculate a depreciation table for the straight line method. To the board. Okay, gang, we are going to rock and roll into the first illustration of how to properly calculate, in my opinion, the easiest depreciation method of them all, the straight line method. And so without any further ado, let's get to it. January 1st, It's a Joke purchased a private jet for $40 million. It's a Joke expects the jet to remain useful for 6 years with a total of 3,700,010 miles and to have a residual value of $4 million. The company expects the plane to be flown 1 million miles the first year, second year 200,000 miles, third year 500,000 miles, no miles flown in year 4, fifth year 2 million miles, sixth year 10 miles. Compute the depreciation schedule assuming straight line. So let's identify some key words that we actually need. The factors that we need for straight line depreciation are the cost, which is $40 million, the salvage value or residual value, which is $4 million, and the number of years, right, which happens to be 6 million. So with those 3 key factors, we could calculate depreciation expense under the straight line method. And based on our formula, we know that the straight line is equal to cost minus salvage value divided by number of years. And so we could easily plug that in because we know the cost is 40 million, the salvage value is 4 million, and if we divide it into the 6 years total, that will give us a depreciation expense amount of $6 million per year, gang. And so now that we have the proper calculation for our depreciation expense each year, we can make the adjusted entry for depreciation at the end of this year. Obviously, we would debit depreciation expense and credit accumulated depreciation / of course, we're talking about a plane, right? For the 6 mil. And that's it, gang. We would make that journal entry at the end of each year throughout the life of the 6 years. And so what I like to do now is show you how to properly create a depreciation table based on straight line. So in order for us to calculate a proper straight line depreciation table, we need these following columns in order to calculate the correct amount. And so the first column is simply just the depreciable cost, which we understand is cost minus salvage value. The next column would be our depreciable rate. And under straight line, the depreciable rate is simply just taking the number of years and dividing it into 1. The depreciation expense is going to give us the calculation for multiplying those two. And our accumulated depreciation will be the amount that accumulates throughout the life of the asset. Lastly, our book value column will represent our book value at the end of that year, which happens to always be cost minus accumulated depreciation. So let's rock and roll. And so throughout this plane's entire useful life, the depreciable cost will not change. Our depreciable cost will always be $36 million, as well as our depreciable rate. And so if we take 6, the number of years, and divide it into 1, that should give us a depreciable rate of 0.1667, or roughly about 16%. This basically means that the asset is going to be depreciated by around 16% per year. Now that we calculated the two fixed amounts that won't change, let's calculate the first year's depreciation expense. Likewise, we also know, gang, that depreciation expense itself will remain the same throughout the useful life of this asset as well. And we've already calculated that to be $6 million. Now, we also understand that our accumulated depreciation is a contra account to the actual asset plane itself, and it's going to grow each time depreciation is recorded at the end of the period. Therefore, at the end of year 1, our accumulated depreciation will be $6 million. At the end of year 2, our accumulated depreciation will grow to $12 million. At the end of year 3, our accumulated depreciation will grow to $18 million, and so forth. All we're doing, gang, is continually adding our pre-existing accumulated depreciation balance to the new depreciation expense. And last but not least, we must calculate the book value at the end of the period. And book value will always be, gang, the initial cost minus the accumulated depreciation at the current time. Therefore, if our initial cost is $40 million and we subtract $6 million for the first year's accumulated depreciation, that should give us $34 million. And remember, our book value will decrease each year based upon the accumulated depreciation's ending balance. So for year 2, again, our cost will still become $40 million, and we're going to subtract it by the $12 million balance that is in year 2's accumulated depreciation. That will give us $28 million. For year 3, the same rules apply again. $40 million minus the $18 million, which will give us $22 million, and so on and so forth. And so one last thing I want to know, gang, is that at the end of the useful life, at the end of the 6th year, when it's fully depreciated, we already know that the book value must equal the salvage value. Why? Because that is the amount that we exclude from being depreciated. And that's how we know this has been properly recorded correctly. And so that wraps up our illustration of how to properly calculate depreciation expense each year under the straight line method, as well as compute the table. Hopefully that light bulb upstairs was ringing. And if so, please like, subscribe, and share the channel with your friends so they can chase the bag as well. It's always a pleasure having you guys with me, and I hope to see you soon. Bags!